TV18.
Friday saw markets reverse the losses seen on Thursday, led hugely by Reliance and the entire financials pack. The index posting its biggest single-day gain in the last 3 months. For the week, market snapped its a 5-week losing streak to gain close to about 3% or so. All sectoral indices except the IT sector are ending higher. Hello and welcome to a fresh new edition of Taking Stock, the show where we review the week which has gone by, but more importantly, try and prepare you for the week in front of us. I'm Prashant Nair. With me, my colleague Ekta Batra. Ekta, hi.
Hi Prashant. Yes, absolutely. It was quite a rocky week, you'd have to say. But before we get to all the market action, here's what we have lined up on the show for you. To discuss the week gone by, we have Aditya Narain, MD and Head of Research, Edelweiss Securities. For the technicals, we will have Jay Bala of Cash the Chaos join in. We also bring you opinion that we got through the week from the likes of Christopher Wood, Global Head Equity Strategy Jeffries, and Jay Kumar, MD Prime Securities. But before we get to that, here's how the markets fared. Well, for Friday's trading session, it seemed as though it was a good trading session after a long time. The markets recovered all of the losses of the previous day, which was really led by the likes of Reliance as well as financials. On a week-to-date basis, the markets did snap that 5-week losing streak. So the frontline indices gained around 3% each. IT was a loser, but we had all of the other sectoral indices post gains this week. Metals, in fact, was the top gaining index. 38 Nifty stocks gained this week. We had the likes of Eicher, Hindalco, Coal India rising over 10% each. HAL, BHEL, which was to still come out with numbers. Granules, which came out with numbers. MCX, LIC Housing, Nalco, which were a couple of the mid-cap gainers. And from the losing end, we did have the entire diagnostic space, which was under pressure. Pharmaceutical stocks such as Lupin and Manappuram, which were top mid-cap losers. So that's a gist in terms of how the markets fared. But Prashant, if you look at the internals of the week, it was a really choppy session.
You know, it's the last 7 trading sessions. We've had, out of those 7, 4 sessions, we've had 400 plus point moves on the Nifty. So, I mean, it's been, and the numbers will come up on your screen. So today, of course, was 457. But the other statistics are on your screen. And finally, what do you have to show for all of it from the 11th of May or the 12th of May? I mean, the markets are absolutely flat. These kind of movements are very typical of when markets are in downtrends, strong downtrends. I don't want to use the B word, the bear word, but it's typical. We've seen that in earlier phases as well. The markets get very volatile, and big gaps and big gap ups and big gaps down, and intraday volatility as well. So I mean, just to kind of make that point, globally, markets are getting choppy, and more importantly, they're getting fatigued, right, with all this volatility, and they lack a common thread. There is so much. There are so many moving parts. It's kind of tough to make a kind of complete picture and say, well, this is cause, this is effect. So it's kind of disjointed as well, what's happening right now. On Friday, we had something significant. China's rate cut, which many are saying is perhaps the strongest signal yet that the government there wants to save the property sector. The property sector is important for China, as it is for most other countries. And in a way, it is a way to support the overall economy as well. It's important for metals, commodities, and of course, that pack did very, very well on Friday especially. Coming to the US, and of course, the big worry which is out there, it's US and US slowdown, and maybe even at some point, perhaps early next year, a recession, right? So earlier this week, on the 17th of May, we had the Fed chair who actually sounded almost resigned to the fact that, they'll have to do tightening enough, and that'll sort of cause some kind of a recession. His best case, the most optimistic case, was a soft landing. The worst case was a recession. And this is coming in from the Fed chair himself. The point is that, the markets in a way are learning to live without what you would describe is a policy put. I mean, for 12 years, more than that, you always had a situation where central banks were watching your back, which is not the case anymore. The hurdle for the Fed to switch from fighting inflation to fighting economic weakness is going to be very, very high. So don't expect a sharp pivot because the S&P fell another 10%. at least that it doesn't look like that, sort of hearing commentary, etc., which is coming in from the Fed chair himself and others on the FOMC. So that's broadly the gist of how to kind of approach things from here. Expect things to remain extremely volatile going forward as well. Sharp pullbacks notwithstanding. Aditya Narain is with us, Managing Director and Head of Research at Edelweiss Securities. Aditya, great to have you with us here. Appreciate your time. Your thoughts, Aditya? We've got 400-point moves. Should we expect more of this, or do you think things will settle down sooner?
I mean, this has been phenomenally unusual to have every day being so dramatic and in different directions. So I'm not sure if you can get a repeat of this, but I think you will continue to see a certain amount of volatility over the next couple of weeks. Though I would tend to believe that, beyond that, you can't have sustained volatility of this order for very long. And I think it will start petering out a little bit. You see, I think what's happened is that at the moment, what the market initially reacted to was really rate hikes and the impact in terms of valuations. And now I think you're moving to growth fears. So I think, that transition is where you're seeing this volatility. And that's where you are at this point in time. But I think the last week or the last 2 weeks in the US in particular seems to suggest that you're now looking at growth risks. And so to that extent, when it's a single risk, or there's less of transitioning that is going to happen, then I think the volatility will tend to ease off. The market might become a lot duller and a lot slower than what it has been in the last week.
Okay. Aditya, hi, welcome to the show. I wanted to ask you how you would approach stocks such as Reliance now, because that saw quite a surge in the second half of Friday's trading session. Would you put your money into large conglomerate companies where there is less of a risk when it comes to earnings now?
So I think, this environment, I think one thing you must keep in mind, because it's often been compared to the slumps that you've seen in India before, and that is balance sheet risks or leverage risks in the corporate sector. Those are relatively low. So to some extent, a lot of volatility tends to come out of that. I think that is pretty modest, and it's a very good thing that is going for India at this point in time. The debate is more around the P&L, which doesn't tend to move stocks very dramatically. So I think that's one element of it. In terms of stocks like Reliance, I actually tend to believe that if there is going to be an enduring theme over the next couple of quarters and potentially beyond, it's just really going to be this whole energy scarcity and energy premium kind of theme. And I think Reliance tends to fit in well there, whether it is a little bit on the petrochemical side or the oil side or in terms of the new energy side. I think that space is just going to get revalued a little bit simply because of the scale that you've seen at this point in time and the fact that oil prices and oil derivatives have gone up as much as they have. So I think you will see safety in companies which are aligned with the oil theme or the energy theme. And I think that is something that works to Reliance's favor. Whether it's a conglomerate theme or not, I'm not so sure. I think the oil theme or the energy theme will tend to be a little bit more dominating.
And Reliance has got, in terms of energy, new energy, old energy, it's got the works. Well, Aditya, I want to ask you about IT, but let's just set this up with Rima, who's standing by, with a quick sense of what really happened, because that was the one space which was bleeding sharply at one point, stabilized towards the close of the week, but Rima will tell us more. Rima.
Thanks so much for that. I'm smiling, but IT stocks took a tumble this week, extending their year-to-date losses to more than 25%, mirroring the sell-off that we had in NASDAQ. And now increasingly, there is so much chatter about a US recession, a global recession, and that's going to hurt technology spending, which will eventually slow down growth for the IT services in the next 1 or 2 years. Also, market fears that consensus expectations are way too high on margin front. So there is a margin risk going into the rest of the year. This week, we had brokerages bring down their outlook on the IT sector. So JP Morgan downgraded the IT sector to an underweight. They cut the target multiples by 10 to 20%. And here I'm quoting from the JP Morgan report, rising margin headwinds in the near term and revenue headwinds in the medium term from a potential macro slowdown will mean the sector's earnings upgrade cycle is behind us. stocks. It wasn't just JP Morgan, even Nirmal Bang. In fact, Nirmal Bang has downgraded their assessment on IT sector for the second time in the last 3 months. Now the rating on the IT sector is that of a sell. And look at the way year to date now these large cap IT stocks have tumbled. We've seen losses of 35-40% coming through for Tech Mahindra and Wipro.
Rima, thanks very much for that. Aditya, is tech still slated to eat the world, as they say? And would you buy stocks here? Go on.
Okay, so since we've dialogued on this over an extended period, we had been for some time actually very much on the bullish camp. We are kind of tempering that view. Now that's in part on two elements, not what you're seeing bottom up. Quite honestly, bottom up, if you listen to managements, if you see what's going around, I think order books, the outlook on orders, and on revenues continues to be actually very, very positive. I think what has happened is that you're just getting a macro pressure point in that, people are talking recession and people are thinking recession, and the risks of something like that happening have effectively gone up. So it's not what you see at this point in time, but what the market is anticipating 12 months, 18 months down the line. I think that is where the challenge has effectively come up. So you had that element where there has been a shift. And I think, quite honestly, in the US, it's been pretty decisive over the last fortnight. The second element is that I think the cost pressures that these businesses are facing, they're tending to extend a little bit beyond. And I don't think that will ease off necessarily very quickly. So I think that, I think Rima made that point that margins could be under pressure. I think that starts playing through. And I think the third thing is that valuations are at the end of the day on the higher side. They are one standard deviation above their means. They're still well above pre-pandemic levels. And I think that combination is actually at the end of the day tempering what was a pretty bullish view for an extended period of time. So I'd be a little bit more cautious on them. I'd still say the risks are not necessarily very pronounced because stocks have come off a little bit, but they just might be laggards in any rally that you see, either from a top-down perspective or from anything that's more local that might play through. Okay. So a little bit more tempered out here, simply because of the overhang of that so-called recession and the possible implications as far as the demand books are concerned.
Okay, so you're tempering your expectations on IT, but what about metals, Aditya? Because metals rallied 7% this week and China's cut rates. Would you put incremental money there?
We have very low expectations. There is not a question of tempering expectations. We think if you can be so cautious on IT, or if the market can start extrapolating risks to growth on IT, I think they would be more pronounced as far as the metal space is concerned. So we are actually running a zero weight in our model portfolio. And while they've generally held well, in the light of the broader macro, I do believe that if, let's not say worst case scenarios, but if difficult case economic scenarios play through, metals will probably tend to lag a bit. You must also remember that the operating leverage for these stocks is very, very high, very, very price sensitive. So the volatility around them tends to be very large. So if you're bullish on the market from an overall context, that'd be a place to go there. But if you're a little bit more circumspect, then I think metals you need to be much, much more watchful on.
Aditya, is it too early to come out with top 5 stocks to buy in this drawdown kind of a report, or is it?
Well, we need to do that all the time. So I don't think it's
No, it's not about you, but you think that we are at that point where, it makes sense to do that?
So I think what has happened is, you see, if you were to look at the Indian market, there was a point in time, literally a month ago, when it seemed, fairly overvalued. I think the overvaluation has come off, right? So it does make things a little bit more attractive. I think the challenge that you face is in terms of whether growth risks for the domestic market are fully factored in. And I suspect not. I think the valuation froth has come off. The growth risks, I think, are still slightly embedded and are not fully factored in. So it's not like a time where you go in and say, this is the time to buy. But I do believe that there are certain themes that you can play very comfortably. There is the two-wheeler theme, which we are comfortable with. There is the private banks and the private insurance theme that we think one can be very comfortable with. And at a portfolio level, I think pharmaceuticals with an India market bias I think that's a place to be fairly comfortable. So I think there are small pockets of value. It's not undervalued as it were. But if you have money to deploy, we can find you places to deploy money.
Okay, definitely, Aditya. So we'll definitely touch base with you on those ideas which you're probably propagating at this point in time. It's been a pleasure. Thank you very much for joining in and speaking with us on CNBC TV18. Time for a short break now. On the other side, we'll be joined by Jay Bala of CashTheChaos.com to discuss the technicals for the next week. But before that, let's leave you with some market opinion that we got through the week.
This is a year of consolidation in the market where you want to be adding to your favorite stocks on corrections. The big surprise to me and my colleagues so far this year is how resilient the Indian market has been in the context of what's going on in the US and in the context of very significant foreign selling of Indian equities. On India, so first of all, India, I still believe India is the best equity story on a 10-year view, not just in Asia, but globally. It's a very strong domestic demand story. India has one huge advantage over the other Asian nations who are getting investment, be it, I would cite Vietnam, Thailand, Malaysia, because India has this huge domestic market.
My assessment is that valuation-wise, our markets have corrected to reasonable levels. A lot of sectors are going at multi-year lows. I mean, when was the last time you saw a correction of 15-18% and you have a multi-year low on something like HDFC Bank?
The problem with being in a bear market is that you can have some very vicious bear market rallies. We think a recession is probable in the US, probably late this year, shorter, maybe more mild. At least that's what the data suggests to us right now.
The difference between the cyclical bear markets and the structural bear markets is the cyclical ones don't last very long. They only last a few months. And so if we are in a bear market, I think we probably are. I think it'll be over by the end of the summer.
It's always difficult to pinpoint what levels we will go to. But it certainly looks like that we are in a short to medium term downtrend. And I think that, probably we will continue to see some earnings and margin pressure going into Q1.